In this lesson, we turn our attention to the statement of cash flows. So far, most of our focus has been on recording transactions, updating balance sheet accounts, and understanding what gets reported on the income statement. While those statements are incredibly useful for determining what a company owns, who they owe, and how they're performing this year, the statement of cash flows is the statement that most analysts and professional investors turn to first when trying to determine whether a company is even worth investing in. By the end of this lesson, you'll be able to explain what the statement of cash flows is for and classify any cash flow into one of its three sections. Net income is prepared on an accrual basis, meaning we might recognize revenue before we collect the cash and record expenses before we actually pay for them. It's very useful for understanding performance because it allows us to look at our revenues and expenses at the same time, even if the timing between when we collect cash and when we pay cash is different. But cash flow is what actually pays off debts, distributes dividends to shareholders, and allows companies to grow and expand. If I want to determine what a company is worth, not just how they performed, I would build a valuation model based on cash, not accruals. That's why analysts ultimately price a business on the cash that it can generate, not the income it reports. This is what drives stock price. If I were to try to estimate whether Nike's stock price would go up or down next year, I'd want to look at a lot of things, but I'd be most interested in the cash that they've been able to generate rather than the income that they've reported. Here's a quick puzzle for you. A company reports net income of $2 million, its best year ever, and 3 months later, it can't make payroll. Again, this is because net income is an accrual number. It counts revenue that the company hasn't even collected yet, and then it spreads out costs that the company has paid for potentially years ago. Net income, in a very real sense, is an approximation, what we expect to happen based on real transactions in 1 year's time. But cash is a fact. The statement of cash flows exists to answer one deceptively simple question. We started the year with a certain amount of cash, and we can see on our balance sheet and our bank statement that number was different at the end of the year. What happened in between? Did the company collect all of its revenue from customers? Did it pay all of its bills? Did it invest money in something else that might contribute to growth? How did it actually operate its business during the year? Here's the way I want you to think about the whole statement. Every single cash flow a company lands in exactly one of three buckets. Bucket 1, operating activities. This is cash from the stuff that shows up on the income statement. Collecting from customers, paying suppliers, paying employees, paying taxes, day-to-day business activities. Nike's core activities, for example, are selling shoes and sporting goods. That's what goes under operating. Bucket 2, investing activities. This is the company deploying its cash for the long haul, buying and selling property, plant, and equipment, buying and selling investments in other companies, or making loans and collecting them back. Bucket 3, financing activities. This is where the money comes from in the first place and how it goes back. Issuing stock to shareholders, borrowing and repaying debt from the bank or other investors, paying dividends, buying back shares. Think of it as transactions with the people who fund the company, owners and lenders. Categorizing a company's transactions into these three different buckets is extremely useful for answering different types of questions we might have about how the company is operating their business during the year. So let's practice the sorting with the table on this slide. Sale of inventory. That's revenue, income statement territory. So we're going to call that an operating activity. Purchase of a building. This is a long-term asset, something that we are investing in. Issuing bonds. This is where we're borrowing from lenders, financing our business. So we'll call that a financing activity. Paying a cash dividend, a transaction with the owners that invested in the company to begin with. That's how we finance the business. So when we distribute dividends to them, we'll also call that a financing activity. Selling a piece of equipment, long-term asset, leaving. This is an investing activity. And here's one that surprises people, paying interest on bonds or any other type of debt. You might be thinking that this one belongs in financing. Bonds are debt, but we actually consider any cash paid for interest to be an operating activity. This is because it actually has to do with an interest expense, an item that shows up on the income statement. Let's look a little bit closer at interest and also dividends. Although your instinct says interest paid belongs with the debt in financing, under US GAAP it doesn't. Interest expense is on the income statement, so interest paid is operating. Another way to think about it is that debt is something borrowed, just like we might borrow office space or a copy machine. In those cases, we'd pay rent. an operating expense. So I want you to think of interest as rent on something that we're using that isn't ours. But instead of renting office space, we're renting a bag full of cash. Dividends are another tricky one. Dividends received are operating, but dividends paid are not an expense. They're a distribution to owners. The company belongs to its owners. They've financed the whole operation and are entitled to its income. So dividends paid go in financing. Second, some big transactions never touch cash at all. Buy equipment by signing a note payable. Acquire a right of use asset by signing a lease. Issue stock to buy land. No cash has moved, so nothing appears on the cash flow statement itself. But these are all still very important investing and financing events, so GAAP requires them to be disclosed separately as non-cash investing and financing activities. Put the three buckets together on the statement and it almost builds itself. Net cash from operating activities, plus net cash from investing activities, plus net cash from financing activities equals the net change in cash for the year. Add the beginning cash balance, and you're going to land exactly on the ending cash balance from the balance sheet. That's the built-in self-check. And I mean exactly. If you're off by $1, something's misclassified or missing. You'll use that check constantly in your homework. To wrap up, the statement of cash flows explains the change in the cash balance. Cash facts, not accrual expectations. The cash flow statement is organized into different types of activities: operating, investing, or financing. This is a useful distinction when trying to understand how a company used its capital during the year to run the business. Interest and dividends are a little less intuitive, so pay attention to the reasons for their categorization. And remember to disclose significant non-cash investing and financing deals. Next, we'll actually prepare a statement from the ground up.